Have you ever noticed that whenever an economic crisis hits, it seems like the rich just get richer while everyone else struggles to stay afloat? It's not just a feeling, it's a pattern that has repeated itself throughout history. From the Great Depression to the 2008 financial crash and even the recent pandemic, the wealthiest individuals often emerge not just unscathed, but even more prosperous. So what's their secret? How do they turn a crisis into an opportunity? Today we're going to pull back the curtain and explore the real evidence-based reasons why the wealthy often benefit during economic downturns. Let's start by looking at some historical examples. Think back to the Great Depression in the 1930s. The stock market crashed, losing nearly 90% of its value. Millions of Americans lost everything: their jobs, homes, and life savings. Yet at the same time, individuals like John D. Rockefeller saw their fortunes grow. How? By holding cash and buying up stocks and real estate when they were dirt cheap. While others were forced to sell at a loss, the wealthy were on a shopping spree, acquiring valuable assets for pennies on the dollar. Fast forward to the 2008 financial crisis. The collapse of the housing market wiped out trillions of dollars in wealth for ordinary families. Many lost their homes to foreclosure. But what about the super rich? Data from the Federal Reserve shows that the top 1% of households experienced far smaller losses compared to the bottom 50%. Billionaires and hedge funds actually made massive profits by betting against the market or swooping in to buy up distressed assets, like foreclosed homes, which they later rented or sold for a huge return. And we just saw it happen again during the COVID-19 pandemic. While millions faced unemployment and economic hardship, a report from the Institute for Policy Studies found that American billionaires saw their collective wealth increase by over 30% in just the first year of the pandemic. So this isn't a coincidence. There are specific mechanisms at play that give the wealthy a massive advantage. The first and most obvious one is diversification. Most people have their wealth tied up in a few things: their job for income and maybe their house as their biggest asset. If they lose their job or the housing market crashes, they're in big trouble. The wealthy, on the other hand, have their money spread across a wide range of investments: stocks, bonds, real estate in different countries, private companies, commodities like gold, and more. If one area takes a hit, another might be doing just fine or even thriving. This diversification acts as a powerful shield against market shocks. Next up is their access to cheap money and government support. When a crisis hits, governments and central banks pump money into the economy to keep it from collapsing. They offer low-interest loans and bailouts. But who gets first dibs on this support? It's usually large corporations and wealthy investors. They can borrow huge sums of money at incredibly low rates and use it to buy more assets. Meanwhile, ordinary citizens might be struggling just to get a small loan, or might be facing foreclosure because they can't make their payments. The system is designed to provide liquidity to those who already have capital. Another key advantage is information. The wealthy have access to teams of financial advisors, market analysts, and exclusive research that most of us never see. They get early warnings about potential downturns and expert advice on how to position their portfolios. While the average person might get their financial news from the evening headlines, which often causes panic, the rich are making strategic moves based on sophisticated data. This information gap allows them to act proactively, selling before a crash or buying at the very bottom, while many retail investors end up panic selling at the worst possible time, locking in their losses. Then there are the advanced investment strategies that are simply out of reach for most people. We're talking about things like hedge funds, derivatives, and short selling. Short selling, for example, is a way to bet that a stock's price will go down. So, while everyone else is losing money, as the market falls, these investors are actually profiting from the decline. They use market volatility, the very thing that scares most people, as a tool to generate returns. Beyond these practical advantages, there are deeper systemic factors at play. Decades of rising economic inequality have concentrated immense wealth and power in the hands of a few. This concentration allows the rich to absorb financial shocks much more easily. If a billionaire loses 20% of their net worth, they're still a billionaire. But if an average family loses 20% of their net worth, it could mean losing their home or their ability to retire. Government policies often reinforce this. Bailouts for big banks, tax cuts that favor corporations and investors, and subsidies for certain industries all tend to benefit the wealthy more than the average worker. Furthermore, our economy has become increasingly financialized, meaning more and more of the country's wealth is generated from financial assets rather than from wages and production. This naturally favors those who own the assets. In fact, data consistently shows that the gap between the rich and poor widens after major financial crises. Finally, there's a crucial psychological difference. For most people, a market crash triggers fear and a feeling of scarcity. The natural instinct is to sell everything to prevent further losses. But wealthy investors have a different mindset. They've been taught to see downturns not as a threat, but as a once-in-a-decade opportunity. As the famous investor Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." They have the capital and the risk tolerance to go against the crowd and buy when everyone else is selling. Their extensive networks in finance and business also give them the confidence and expertise to make bold moves when others are paralyzed by uncertainty. So what can we learn from all this? For policymakers, it is a clear signal that crisis interventions need to be designed more equitably to protect the most vulnerable, not just to prop up financial markets. We need to address the systemic issues that allow wealth to concentrate at the top. For us as individuals, the lessons are clear. Financial education is non-negotiable. Understanding concepts like diversification, long-term investing, and the importance of having an emergency fund can make a huge difference in our ability to weather a storm. It is about building our own financial resilience so we're not as vulnerable to the next crisis. While we may not have the same advantages as the super rich, we can adopt some of their principles, thinking long-term, avoiding panic selling, and continuously learning about how money works. In conclusion, economic crises act like a magnifying glass, revealing and amplifying the deep inequalities in our system. The wealthy aren't just lucky. They leverage a powerful combination of diversified assets, access to capital, superior information, and a strategic mindset to protect and even grow their fortunes. By understanding these mechanisms, we can all become smarter about navigating our own financial futures and advocate for a fairer, more resilient economy for everyone. Thanks for watching. If you found this breakdown insightful, be sure to like the video and subscribe for more deep dives into how the economy really works. See you in the next one.